Hello and welcome. My name is James Preston. I'll be your MC for today. I'm at the headquarters of Peak Investment Partners, and today I'm sitting down with the Chief Investment Officer of Peak Investment Partners, Ian Wenham, and we're going to find out everything ahead for the year for Peak and the market. So Ian, first question, and it's a topical one. We've just had the Turnbull government's first budget. Is the equity market a winner or a loser?
Very good question. I think our overall assessment was that generally it was a pretty neutral budget, very much an election budget designed not to upset people before the campaign even commenced. And in our view, there wasn't a lot in there which was particularly controversial. Interestingly, perhaps the most controversial part was some changes, some fairly material changes to superannuation, which in some respects were far more significant than reforms that we've previously seen around superannuation. High income earners have been a little bit destabilised by some of the measures that have been put in place. But overall, I think the budget's pretty neutral, and watch the election campaign, I think, for some of the more significant initiatives.
On the day of the budget, we had a further rate cut. Do you see that supporting the market despite the Reserve Bank's concern about the economy?
Overall, I think the rate cut was certainly a surprise, at least it certainly was to us anyway. I think the general market reaction, as you've seen since the rate cut, has obviously been relatively positive. On the day of the announcement, we had a sort of very strong rally, particularly in some of the yield stocks. I think our overall view is that the interest rate cut will certainly keep money flowing into some of the more high-yielding sectors of the market. So I think net, while it was a little bit of a surprise, the fact is that dividend yields of our market is around the 4.5% level, which compared to term deposit rates, which will probably now be somewhere around about the 2.5% level, obviously equities are quite attractive. So overall, I think the Reserve Bank were very keen to keep the Australian dollar at a level that was supportive of the transition that our economy is under at this point in time. And when it got to up towards that 78-cent level, I think the RBA were quite prepared to take the initiative and cut again.
The Aussie banks make up the largest slice of most retail portfolios, and we've just seen the interim results from WBC, ANZ and NAB. What is Peak's opinion of the banks at current levels?
Well, overall, banks have had a big correction over the last few months. In fact, from April, May last year, bank share prices have declined by around 25 to 30%, which is a big fall certainly for banks that are reporting relatively flat earnings. The market overall has been far more concerned about where the banks are going from here. There's a number of significant headwinds that are in place at this point. Things such as the increased capital requirements, the banks are being forced by regulators to carry. Credit growth is slowing as the housing cycle matures. There's concerns about potential bad debts increasing off cyclical lows, and generally slower earnings growth, and in some respects dividends under pressure. So overall, I think we're a bit cautious about banks medium term. Short term, I think they look quite attractive to the extent that they have fallen by 30%. But our overall stance going forward will be probably to maintain an underweight position to the sector overall.
In a low growth, low return world, where is Peak investing to lift returns?
Good question. Interestingly, in the last 12 months, we've had quite a significant underperformance by the leaders. Our focus has increasingly switched towards the small and mid-cap sectors of our market, specifically things like the Asian or the China middle class, emerging middle class. We think offers some very interesting prospects for Australian companies. On the export front, things like food, we see some attractive opportunities there around companies such as Bega and Blackmores. In technology, companies such as Aconex and WiseTech, we think also look very attractive.
Despite the fall in the Australian dollar following the last rate cut, should Aussie investors be looking offshore?
Yeah, certainly. I mean, Australia, the market is very limited. As I said earlier, Our market is very much a resources and banking financial services market, controlling roughly half of the market capitalisation. So a number of key industries such as technology, we don't really have here in Australia in a major way. To get exposure to the world's best technology companies, one does certainly need to look offshore.
How sustainable is the rebound in commodity prices?
Well, we've seen a very strong rebound over the last few months, and while that was off very long-term cyclical lows, i.e. lows that we last saw in the 1980s and 90s, which is typical of a commodity price cycle. However, the strength of the rebound has certainly surprised most pundits, with the oil and gold and iron ore prices rising significantly. We think we've probably seen the lows in a long-term cyclical sense, but we don't see the backdrop at this point as far as supply and demand balances are concerned for any sustainable long-term uptrend in commodity prices.
Is low inflation good or bad for the economy?
The way we look at inflation is there are different types of inflation. In our view, asset price inflation is generally positive. One does need to see prices of assets over time increasing. The reverse of that obviously has been Japan, where serious asset price deflation over a long period of time has been very detrimental to the economy in aggregate. Goods and services inflation, on the other hand, is generally positive, and we're seeing that here in Australia. The prices of many goods is rising at a slower rate than it has for generations, and the consequences of that are actually generally very positive.
Ian, it's been a pleasure chatting with you. What is Peak expecting moving forward with the markets to close out the year?
Prospects for the end of the year generally will be, I think, choppy. Obviously, with elections in Australia, the US, and with Brexit in the UK, these are all quite significant political events that will create volatility, no doubt. Peak is quite positive about earnings prospects for companies going into 2017, particularly on the industrial side, and to the extent that we think the resources sector is probably down near some sort of a longer-term low as far as earnings are concerned, then I think 2017, or going into 2017, will be an okay year. Seasonally, the period between May and October tend to be weak periods in terms of an equity market cycle, and so we would expect the year to be finishing better than perhaps it is through that May to October period.